Committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. Votes are scheduled in the 3:30 to 4 o'clock range. Hopefully we'll be able to get through everybody's testimony and questions ASAP, so we're going to try to get going here as quickly as possible. This hearing is entitled The Impact of Domestic Regulatory Standards on the Competitiveness of U.S. Insurers. Before we begin, I'd like to thank the witnesses for appearing before the subcommittee today. I look forward to your testimony. And I now recognize myself for 4 minutes to give an opening statement. Our nation enjoys the most robust policyholder-centric insurance system in the world. U.S. industry performed well during the financial crisis, and policyholders enjoy the safety and soundness that comes with our nation's unique regulatory structure. Despite its proven track record, the domestic regulatory landscape is being forced into significant changes. Today, we see more intrusion in insurance by not only the federal government, but also international financial regulators. Dodd-Frank has allowed that to happen through the creation of the Federal Insurance Office and the powers granted to the Federal Reserve Board of Governors. The subcommittee has spent a great deal of time focused on the international factors affecting our insurance market. Thanks to Team USA, we have experienced some victories at the International Association of Insurance Supervisors. The timeline for an international capital standard has been extended, which came as a welcome news to this committee, and conversations seem to be pointing us in the right direction on accounting standards. However, the approach on the IAIS Higher Loss Absorbency Rule, or HLA, has created some alarm throughout the U.S. insurance space and has the potential to damage our domestic system. The proposal unjustly harms products relied on by millions of American consumers, an issue that must be addressed without delay. It is imperative that the United States press the IAIS and the Financial Stability Board to push back on this concept and work toward what should be the mission of Team USA to represent and advocate for the existing insurance regulatory regime. Today, we turn our attention to the many domestic pressures facing the industry, from the designation of insurers as systemically important financial institutions to the Federal Reserve's rulemaking on insurance capital standards. It's essential that changes made to the regulatory landscape be done appropriately and in response to issues that pose risk to policyholders. That is particularly true of the Fed's domestic capital standard. This standard should be done in close coordination with state insurance regulators and should be tailored to meet the unique model and needs of the United States, not based on international conversations or the desire to appease federal and foreign regulators. There is a tremendous need for the Federal Reserve, which, as a reminder, is subject to congressional legislative action to get this rulemaking right. It is imperative that the Fed develop a domestic standard first, then export it to the rest of the world. It is my hope that today's discussion also focuses on the designation of insurers as SIFIs. The administration has told this committee time and time again that decisions on these designations were not born of international conversations and were made based on the extensive research and actual risk posed to the financial system. Yet insurance experts in this room, from whom we will receive testimony today, dissented and have, in subsequent situations, outlined their concerns over these designations. There are numerous other issues that have the potential to negatively impact the competitiveness of U.S. insurers. Despite statutory language that call for a board to be established by April, we've yet to see any progress on NARAB 2. We continue to prop up a flood insurance program that doesn't work and are now requiring the insurance industry to comply with costly, duplicative data requests at both the state and federal levels. Ultimately, while some progress has been seen internationally, I fear that coordination and cooperation has stalled domestically. It's time that the witnesses appearing today work with Congress, industry, and most importantly, each other to ensure that our domestic insurance system remains the most robust in the world. With that, the chair now recognizes the ranking member of the subcommittee, the gentleman from Missouri, Mr. Cleaver, for 5 minutes for an opening statement.
Thank you, Mr. Chairman. To the other members of the subcommittee, good afternoon. I would like to begin by first thanking our witnesses for their appearance here today, and I'd like to issue a special welcome, of course, to John Huff from the great state of Missouri, which is preparing for an I-70 World Series. I'm not saying other teams are not important, they're just not winners, but what I would like to do is welcome all of you, but obviously I have a special appreciation for the Missourian. Today's hearing will focus on domestic insurance issues with the passage of Dodd-Frank Act. The Federal Insurance Office, the FIO, was also created. Among many things, this office monitors all aspects of the insurance industry and identifies any gaps that could contribute to the systemic crisis. The U.S. insurance industry is, of course, primarily regulated by states. However, the consequences of the 2008 worldwide economic crash revealed the extent to which our U.S. financial regulatory framework had allowed for supervisory gaps to exponentially grow. There was simply no single regulator responsible for understanding and supervising the enterprise as a whole. Though changes have been made to our insurance system as a whole, much of the state regulatory power remains. The FIO is not a financial regulator. It is not a financial regulator. They have been, as authorized by Dodd-Frank, working on a number of issues on the domestic level, many of which are referenced in their annual report on the insurance industry that was released yesterday. Overall, both the life insurance and property and casualty insurance sectors were profitable in 2014. Life insurance net written premiums totaled $648 billion in 2014, and property and casualty net written premiums reached $503 billion in 2014, which was a record high. I'd like to again thank our witnesses for their participation, and I'm eager for this conversation on domestic insurance issues to continue, and that we will have a robust dialogue. Thank you very much, Mr. Chairman.
Thank you, Mr. Cleaver. With that, we'll begin the testimony. Today we welcome Director McGrath from the Federal Insurance Office, U.S. Treasury Department, Mr. Tom Sullivan, Senior Advisor, Department of Bank Supervision and Regulation, Federal Reserve Board of Governors, Mr. John Huff, Director, Missouri Department of Insurance, Financial Institutions and Professional Registration, and President-elect of the National Association of Insurance Commissioners. Obviously, Mr. Cleaver and I have a connection to Mr. Huff, and welcome him, a special welcome. And the Honorable Roy Woodall, Jr., independent member of the Financial Stability Oversight Council, U.S. Department of Treasury. Gentlemen, thank you for being here this afternoon. We have a very distinguished panel, and I'm excited to have you with us. You'll each be recognized for 5 minutes to give your oral presentation or testimony. Without objection, your statement will be entered as part of the record. If you don't know the new system or the new boxes we have in front of you there, just punch the button, you're automatically into the microphone. When you see the yellow come on, you got a minute to go, and it's red, you and I'll have to have a discussion about cutting it off. So with that, Mr. McGrath, you're recognized for 5 minutes.
Chairman Lukemeyer, Ranking Member Cleaver, members of the committee, thank you for inviting me to testify. We released FIO's 2015 annual report on the insurance industry yesterday. 2014 data showed the $8.3 trillion U.S. industry reported capital and surplus levels of approximately $1.15 trillion. Total direct premiums collected in 2014 were a record high of $1.2 trillion, or roughly 7% of U.S. GDP. Just in the last 10 years, U.S. premium volume has grown by more than $170 billion. At FIO, we are working to implement the reauthorized TRIA, including working with stakeholders so that we collect meaningful data in an efficient way. Industry continues to educate us about what data is available and in what format. We are also prepared to release soon a study on the TRIA certification process. FIO is also moving forward with monitoring the affordability and accessibility of personal auto insurance. We need a standard that makes sense from an insurance perspective, and stakeholder input has provided great insight. FIO also serves as a non-voting FSOC member, participating in the analysis of systemic risk and individual firms. In this work, we work closely with staff from other FSOC member agencies, including those represented on this panel. Our annual report also cites data showing that while U.S. premium volume increased in 2014, the U.S. share of the global insurance market declined from 27.5% to 26.8%. This development reflects both the continued vibrancy of the U.S. market, by far the world's largest, and the increasing global growth opportunities for U.S.-based insurers. The globalization of the insurance market explains the increased focus on global standards, and for this reason, among others, FIO has the statutory role to coordinate and develop federal policy on prudential aspects of international insurance matters, including representing the United States at the IIS. In this work, we collaborate extensively with our colleagues at the state level and at the Federal Reserve. Importantly, international standards are not self-executing in the United States. Federal and state authorities will study, test, and analyze the potential value and impact of any international standard prior to implementation. The U.S. has the most diverse and competitive insurance market in the world, with insurers operating in one part of one state and insurers that are multinational and engaged in a variety of financial services. With this in mind, we work with our U.S. and international counterparts to build a global consensus that works for the United States. In 2014, the IIS completed structural reform that improved the organization's transparency, and we're pleased to note that in 2015, stakeholders have already had more than 60 hours of public engagement with IIS members, far more than ever before. With open meetings available to all stakeholders, the IIS is better able to fashion fact-based standards. One such standard, known as higher loss absorbency, or HLA, will be completed as an initial version this year, but subject to meaningful improvement in the coming years. We also hope to commence negotiations on a covered agreement soon. Before we do, we will notify and consult with this and other committees. We look forward to meaningful engagement with all stakeholders throughout the covered agreement process. Not a trade agreement, a covered agreement is an agreement between the U.S. and another country involving prudential insurance measures. Our objective will be to provide tangible benefits for the U.S. insurance industry and consumers. Through our respective roles at home and abroad, U.S. authorities will continue to provide leadership that complements our shared interests in a vibrant, well-regulated market that promotes competition and financial stability and that protects consumers. In all of our work, internationally and domestically, Treasury priorities will remain the best interests of U.S. consumers and insurers, the U.S. economy, and jobs for the American people. Thank you for your attention. I look forward to your questions.
Thank you, Director. Mr. Sullivan, you're recognized for 5 minutes.
Thank you, Mr. Chairman, Ranking Member Cleaver, and other members of the committee. I appreciate the opportunity to testify on behalf of the Federal Reserve. As a result of the Dodd-Frank Act, the Federal Reserve is responsible for the consolidated supervision of insurance holding companies that own an insured bank or thrift, as well as insurance holding companies designated by the FAFSAC for Federal Reserve supervision. Insurance holding companies for which the Federal Reserve is consolidated supervisor hold roughly $3 trillion in total assets, which is roughly 1/3 of the U.S. industry assets. These insurance holding companies vary greatly in terms of their size, the products they offer, and their geography. After passage of the Dodd-Frank Act, the Federal Reserve moved quickly to develop a supervisory framework that is appropriate for insurance holding companies that own depository institutions, and we promptly assigned supervisory teams to handle day-to-day supervision of each company. We have also acted promptly to commence supervision of 3 insurance holding companies designated by the FSOC for Federal Reserve supervision. Our supervisory teams are a combination of experienced Federal Reserve staff as well as newly hired staff with insurance expertise. We currently have approximately 90 full-time equivalent employees devoted to the supervision of insurance firms. Many of our supervisors are individuals with substantial prior experience in state insurance departments or the insurance industry. We plan to continue to add to staff as appropriate at both the board and the reserve banks to ensure that we have the proper depth and experience to carry out our mandate. Our supervisory efforts to date have focused on strengthening the firm's internal controls, corporate governance, risk identification, measurement, and risk management. Our principal supervisory objectives are protecting the safety and soundness of the consolidated firm and their subsidiary depository institutions while mitigating any risks to financial stability. Last year, Congress enacted the Insurance Capital Standards Clarifications Act, which amended the provision of the Dodd-Frank Act that had required minimal capital standards for banks be applied to any insurance holding company supervised by the Fed. Using greater adaptability provided by this amendment, the Federal Reserve is now focusing on constructing a domestic regulatory capital framework that is well-tailored to the business of insurance. We are exercising great care as we approach this challenging mandate. The Federal Reserve is investing significant time and effort into enhancing our understanding of the insurance industry and the firms we supervise. We are committed to tailoring our framework to the specific business lines, risk profiles, and systemic footprints of the firms we oversee. We have increased our staffing and have been engaging extensively with other insurance supervisors, experts, regulated entities, market participants, and others to solicit feedback on the various potential approaches to the development of an appropriate consolidated group-wide capital regime that would be consistent with federal requirements. Our consolidated supervision and capital requirements will supplement existing legal entity supervision with a perspective that considers the risks across the entirety of the firm, including risks that emanate from non-insurance subsidiaries and other entities within a group. Our role as a consolidated supervisor does not seek to lessen the critical importance of supervising individual insurance legal entities by the states. We do not regulate the manner in which insurance is provided by these companies or the types of insurance products they provide. Those important aspects of the actual business of providing insurance are the province of the relevant state insurance supervisors. We conduct our consolidated supervision efforts in the manner that is complementary to and coordinated with other insurance regulators. We do this both informally and formally through mechanisms such as supervisory colleges. We also enter into agreements that allow us to share confidential information with state supervisors. An example of our collaboration with the states is evaluating a company's own risk solvency assessment, or ORSA. Many states have enacted legislation that requires state-regulated insurers to produce this assessment on a group-wide basis. While we recognize that the ORSA process belongs to the lead state regulator, it is a potentially useful and valuable tool for us as well because it is fashioned on a group-wide basis. It has helped us to understand some of the institution's processes for monitoring, measuring, controlling, and managing risks in a way that avoids unnecessary duplication in our oversight function. We've been meeting with state insurance departments to discuss views on ORSA submissions, and we have appreciated their perspective on these subjects. We will continue our active collaboration with state regulators. Mr. Chairman, thank you for inviting me here today. I look forward to an active dialogue with committee members.
Thank you, Mr. Sullivan. Mr. Huff, you're recognized for 5 minutes.
Good afternoon, Chairman Lutemeyer and Ranking Member Cleaver. I appreciate the opportunity to testify today. As insurance markets grow more complex, state insurance regulators' tools and priorities also evolve. While here in Washington, much of the focus has been on the uncertainty of the international landscape, the capital standards the Federal Reserve will impose, and the operations of the FSOC, state insurance regulators have been working through the open and transparent NAIC process to make significant improvements to key areas of insurance regulation. As my written testimony details, in the past few years, state insurance regulators have made improvements to our Holding Company Act that enhance our ability to regulate interactions among insurance companies and other entities within a holding company system. We've begun implementing a principles-based reserving system that right-sizes reserve for life insurers and reduces the incentives for company workarounds, and we've enhanced the consistency and transparency of life insurer use of captive reinsurance that has been primarily used to address, admittedly, excessive reserving requirements for certain lines of life insurance. And we've worked to protect insurance consumers who have been victims of a data breach. In addition to these enhancements, state insurance regulators have reduced the collateral amounts or requirements for foreign reinsurance transactions in a measured and transparent manner. Historically, we required foreign reinsurers to hold 100% collateral onshore in the U.S. to protect U.S. consumers. Responding to concerns raised by foreign reinsurers and foreign governments, we are permitting collateral reductions if a reinsurer is in a solid financial health position and is overseen by an effective regulator in its home country. Today, 32 states have adopted proposed revisions representing more than 2/3 of premiums written in the U.S. across all lines of business. 5 more states are considering similar proposals, which would raise this market share to about 93%. This is an excellent example of states responding quickly to global market developments while preserving our focus on U.S. policyholder protection. Despite extensive state responsiveness, we understand that the Treasury Department and the USTR are preparing to start negotiations on a covered agreement with the EU to address further reduction of reinsurance collateral and resolve uncertainty arising from Solvency II. This federal action could unnecessarily preempt state laws and our progress on reinsurance reforms. We have long contended that although our regulatory system is structured differently than Europe's, it results in similar outcomes and should not be a basis for imposing duplicative regulation on U.S. insurers operating abroad. We question whether a covered agreement or any formal action by the federal government is necessary to resolve equivalence, as it is clear that recognition can be achieved through other mechanisms. Before the federal government begins negotiating directly with a foreign government on an agreement that could preempt our state insurance laws, we do expect a clear and compelling case to be made for such drastic action. No such case has been made. And should Treasury and USTR nevertheless move forward, state regulators should be at the table, directly involved in any discussions or negotiations to ensure our state regulatory system is not compromised. In 2010, I was selected to serve on the FSOC, and I served for 2 consecutive terms until September of last year. I continue to believe that FSOC can be a robust vehicle for monitoring risk facing our financial system. However, FSOC has now voted twice to designate insurance companies over the objections of members who know the insurance industry best. Neither the designated companies nor the primary regulators have been given the insights necessary to de-risk these firms. This is unacceptable and contributes to, rather than reduces, risk to the financial system. If FSOC is unable or unwilling to change its process to develop an exit ramp for designated firms, we strongly urge Congress to do so. SIFI designations are not merely academic exercises. They will have real consequences for firms subject to the Federal Reserve's new capital standards. The NAIC supported legislation last year granting our colleagues at the Fed flexibility to apply capital rules consistent with the insurance business model and our legal entity regulation. For our part, state insurance regulators also support the need to assess the adequacy of an insurance group capital position as part of coordinated solvency oversight, and we are developing our own group capital calculation. In conclusion, state insurance regulators continue our efforts to improve regulation in the best interest of U.S. insurance consumers. State regulation has a strong 145-year track record of evolving to meet the challenges posed by dynamic markets, and we continue to believe that well-regulated markets make for well-protected policyholders. Thank you, and I look forward to your questions.
Thank you, Mr. Huff, for your testimony. Mr. Woodall, you're recognized for 5 minutes.
Thank you, Mr. Chairman, ranking member, and members of the subcommittee for inviting me to appear before you today. As you know, I serve on the Financial Stability Oversight Council as the voting member with insights as to the insurance sector of our economy. The other voting members are federal banking regulators, federal market and housing regulators, and the Treasury Secretary. The work of the Council affects many aspects of the financial system, but most prominently with respect to our domestic insurance market has been the Council's work in designating non-bank financial companies as systemically important financial institutions, or SIFIs. It's been 7 years now since the financial crisis, 5 years since Dodd-Frank was passed, and to date the Council has designated only 4 SIFIs, 3 of which are insurance companies, AIG, Prudential, and MetLife. Upon designation as SIFIs, the insurance companies become subject to federal supervision and regulation by the Federal Reserve Board of Governors. And as Tom Sullivan mentioned, this is regulation in addition to that of their primary regulators, our state insurance commissioners. Thus, the Council's SIFI designations have impacted the regulatory framework of our domestic insurance market more than any other sector of the economy. But it was not the intent of Dodd-Frank that SIFIs be forever regulated by the Fed. Under Dodd-Frank, the Council has to reevaluate the SIFIs each year and then either confirm that they are still SIFIs or de-designate them. Dodd-Frank envisions that over time, the Council and regulators would supervise the SIFIs to eventually eliminate whatever systemic risks they pose to the U.S. system. As I explained in my written testimony, I was critical in the way in which the insurer SIFIs were designated. Dodd-Frank provides two tests for SIFI designation. Under one of the tests, the council can presume that a company is under material financial distress, about to fail, and could pose a threat to the financial stability of the country. This is the only test by which all four of the SIFIs were judged. Under the other test, Dodd-Frank, the council can look at the activities of the company, regardless of whether the company is about to fail, and then judge whether those activities are systemically risky and pose a threat to the financial stability of the United States. The council used the material financial distress test in designating all three of the insurance companies as SIFIs, rather than the activities test, which, as I explained in my written testimony, I had advocated. Now I'd like to focus on what comes next for these three insurance company SIFIs. Had the council used the activities test, as I had advocated, it would have let the SIFIs, other companies, and regulators know what it was about the company's risk activities that needed to be addressed in order to remove whatever threat to the U.S. financial system the companies might pose. As a result of the council's failure to undertake this approach, the companies and their primary regulators are in the dark. It's my hope that the insurance SIFIs are not stuck in a Hotel California, and that the council will begin to provide guidance to the companies and their primary regulators as to what the companies can do to lessen their systemic risk footprint, and not just so they can exit Fed supervision, but so whatever systemic risk they pose can be mitigated and they will no longer pose a risk to the entire U.S. financial system. From my perspective, each year that a SIFI is again judged to still be a SIFI is no longer a reflection on that company. Rather, it becomes a measure of the success and effectiveness of the council and of the Fed supervision. If we are not improving them, and the SIFIs are year after year still found to have systemic risk, what will the labeling of these companies as SIFIs have achieved? As previously stated, I think the council should provide some degree of guidance as to the SIFIs as to how they could mitigate their systemic risk, and I will continue my efforts to encourage the council to provide such guidance. Thank you, Mr. Chairman. I'm happy to answer any of your questions.
Thank you, Mr. Woodall. This panel is going to get a blue ribbon from me with a gold star on it because every single one of you stayed within your 5 minutes. Fantastic. That's a first for me, my 7 years being here. Well done, gentlemen. Let me begin the questioning this afternoon. Mr. Sullivan, Dodd-Frank requires the Fed to develop a domestic capital standard that you discussed a minute ago. Where are you in that process, and when do you expect we can receive the final capital standard?
Thank you, Mr. Chairman. We are not being driven by an artificial timeline to develop that standard. Right now, in terms of our progress, we continue to solicit views from external parties. We continue some degree of internal deliberation as we prepare to present to the board an array of options that could be considered for a domestic capital standard. But we don't have a specific time frame. We continue to work at it. And as I said in my testimony, we have a very open door in terms of soliciting the views from many, including our friends in the state regulatory community and others.
Okay, well, so it could be anywhere from 2 months to 2 years. Is that what you just said?
Well, I don't think this is something we want to hurry or rush along. I think this is something we want to be very careful and thoughtful and deliberate about.
Okay, but that begs the question then, you know, what we'd like to see is a domestic standard set first before we go to the international standard. Would you commit to doing that as well?
Well, ours is an obligation under the law to fulfill our obligations under Dodd-Frank. Standard setting at the EIIS, I would differentiate insofar as Director McCarthy.
Yeah, but are we not putting the cart before the horse? Are we not going to sort of endanger your ability to do your job if the international group decides to set capital standards and suddenly you have to take that in consideration with your standards? Is that not going to happen? Is that not a possibility?
We're not obligated to enact anything.
I didn't say whether you're obligated. I asked if that's a possibility.
I suppose, from a timing perspective, it could play out that way.
So
but
therefore,
we-
my question, Mr. Sullivan, is, are you willing to put in place the domestic standards before you allow the international standards, or agree to putting international standards in place?
Our development of the domestic standard is going to be done on our time frame after a thorough and deliberative process through the board. And anything that we consider internationally will have to meet the test of, is it appropriate for the U.S. market? Is it appropriate for U.S. consumers?
Well, it's hard to understand how it could be appropriate, sir, if you haven't got them in place yet, whenever you try to make a determination on a national basis. Mr. McGrath, would you agree with that statement?
Forgive me for not, I didn't get every word of your comment.
Okay. Mr. Sullivan thinks that we need to take into consideration, I don't want to put words in Mr. Sullivan's mouth. Let him rephrase his comment.
Well, my statement was that we would develop our domestic capital standard on a time frame that we deem appropriate, and that we would consider any international standards for adoption, but they would only be adopted in the U.S. if they're appropriate for U.S. markets.
Okay, if they're
and
appropriate U.S. markets, that's the concern
US
that I have. Mr. McGrath.
I support Tom Sullivan's comments. I think we have two separate issues that are at play. One is the global standard. What we're doing collaboratively is ensuring the U.S. leadership in that conversation is provided. Domestically, which has the force of law and a requirement, the Federal Reserve should proceed in a way that is deliberative and tailored to the companies under their supervision.
Before we go any further, I want to congratulate and thank Mr. McGrath, Mr. Sullivan, for being open and available to myself and this committee. I know that part of our job here is not just legislative, it's also oversight. And to work with Mr. Sullivan, the Fed, and Mr. McGrath at FIO to sort of peek over their shoulder to watch what they're doing, especially with this international discussion that's going on. And they've been very cooperative and very forthcoming, and I want to thank you for that. Mr. Woodall and Mr. Huff, you guys working with the SIFIs and had long comments in your opening statements about it. You know, Mr. Woodall, you talked about the material financial stress and then not using activities. To me, and then not because they don't do that, they can't figure out how to de-risk. This is extremely important. This is a really big problem, because how can you tell somebody doing something wrong, but you don't tell them how you can fix the problem? Would you elaborate just a little bit more?
That restates it beautifully, because if the companies don't know what they need to do to not be a SIFI, then they're in the dark, the regulators are in the dark, and we haven't really accomplished anything.
You know, it's kind of like if you've got a teenage driver and they keep running in the ditch, and you don't tell them you got to turn to the left once in a while instead of keep turning to the right to get in the ditch, they'll never get out of the ditch, will they?
Exactly.
I'm out of time, so Mr. Huff, hopefully you'll be able to answer a question with regards to that shortly. Let me recognize the gentleman from Missouri, my good friend, colleague, and ranking member, Mr. Cleaver, for 5 minutes.
Thank you, Mr. Chairman. I want to continue along the lines that the chairman established. Let me first, I didn't see him earlier, Senator Bill Nelson from Nebraska. Appreciate you being here with us today. Mr. Sullivan, I think I understood every word you said. I'm just a little concerned about it, and I'm wondering whether or not this won't end up being a major mistake. It would seem to me that, you know, I want to set the rules in my house first before I try to pass some city ordinances regulating what youth do. I mean, the curfew I'm going to set in my house. Because if we end up being somehow ending up placing our standards based on international standards, it may put some kinds of undue pressure and influence on our insurance companies. And I know I heard what you said. I just think it's difficult to take into account what's happening internationally if we're going to put this framework together first. I may be asking the same question in a different fashion. Are you concerned about it at all?
We're obviously concerned, but we have a seat at the table. As Director McCraith pointed out in his testimony, the U.S. insurance market's the world's largest insurance market. I failed to see how an insurance standard would be widely accepted around the globe if you ignore the world's largest insurance market. So collectively, with representatives from the NAIC and Director McCraith and the Fed, we're at the table at the IAIS working to fashion and craft an international standard that we believe will be appropriate for U.S. insurance markets and U.S. insurance consumers. That work has, thankfully, because of the good efforts of Director McCraith and Director Huff and others, has been extended. There's, some of the timelines have been pushed out, as Mr. Chairman noted in his opening statement. So I think we have some room. I don't underestimate the gravity of what you've pointed out, Mr. Cleaver, but I think if we continue to work together and represent the U.S. at the international fora, we'll hopefully get something that will be acceptable.
I'm assuming, and maybe it's too, that all four of the witnesses agree with that, or some variance of that?
Congressman, one point that's, I think, important to make is the alternative of not participating in the global discussions would be far more detrimental to U.S. interests than us being involved as we are right now, working together to assert and provide U.S. leadership in those fora. That's exactly what we're doing. When the Federal Reserve develops its rule, it'll be tailored appropriately, following, as Mr. Sullivan said, a lot of good work. That allows us to further lead the conversation. Right now, we want to be sure in these early days of development that we are very clear and assertive about the U.S. views on these important topics.
Okay, I'd like to have more conversation on this, but I want to go to Director Huff. And the Missouri insurance industry is right now about a $34 billion industry with over $112 billion in state chartered financial institutions. What condition would you say the state insurance agency in? I know somebody probably thinks it's a softball thrown up in the air. Please view it as such.
Thank you, Congressman. The Missouri market is very competitive at this point in time in most lines of business. Workers' comp in particular, we have over 320 active writers in the state, and insurers are actively competing for employees to offer workers' compensation. Our auto market has just been rated by an outside source as the 7th most competitive in the U.S. So the auto industry, again, we have about 175 active writers. So those markets are very competitive. The health side, not so much. We are struggling on our health insurance side of having active writers in the market, and really four health insurers control almost 90% of the market. So it's an area we struggle in. The other area that we have quite a bit of expertise is the reinsurance market. We're home to two of the largest reinsurers in the world, and at this point, due to re-domestication of a reinsurer, about 40% of all the life reinsurance in the U.S. is written out of a Missouri domestic.
Thank you. You're back, Mr. Chairman.
Gentleman's time has expired. With that, we go to the gentleman from Florida, Mr. Posey, for 5 minutes.
Thank you very much, Mr. Chairman, and thank all of you for being here today. We really appreciate you taking the time to testify before us today. My question is for Mr. Huff. In your written testimony, it wasn't in your oral testimony, I understand that time constraints wouldn't allow you to expand too much, but in your written testimony, you noted that the National Association of Insurance Commissioners, which consists of chief insurance regulators from the states, which we know excuse me, as political bodies that actually balance their budgets and regulate in a way that we could hope the federal government might achieve someday, do a lot better job of regulating actually, is supportive of House Resolution 1478, the Policyholders Protection Act. And Mr. Chairman, this time I'd also like to submit an additional stack of letters of support for the Policyholders Protection Act that have been received by my office.
Without objection.
I'd also like to echo Mr. Huff's testimony that this bill enjoys a wide support from the states, the consumers in the insurance industry, and the people that it protects. This legislation is a bipartisan effort introduced with Representative Sherman. It would limit the ability of federal bank regulators to raid certain solvency-threatening insurer assets as a source of strength for banks. And my question, Mr. Huff, for you is that I hope you could explain to us in a more detailed manner how this legislation is important to protecting insurance consumers and why policyholders need this protection.
Thank you, Congressman. State insurance regulators strongly support your bill, the Policyholder Protection Act, mainly because it preserves our ability to protect consumers within complex financial firms so that policyholder dollars necessary to pay claims, for instance, for a damaged house or even for a life claim for a deceased breadwinner, those claims are not jeopardized by complex bets, risk-taking, or poor management elsewhere within the firm. The bill ensures that state insurance regulators continue to have the ability to specifically protect insurance-related assets in order to pay claims when they come due, and the policyholders remain protected from undue harm. Insurance regulators have long had the ability to wall off insurance company operating entities within large, diverse financial groups from the risk posed by other affiliates to protect policyholders. And your legislation guarantees a level playing field and confirms that authorities in existing state law and federal law governing bank holding companies apply to insurers organized as savings and loan holding companies. It also clarifies insurance regulators' authority to protect policyholders during a resolution of an insurance company or its affiliate. Thank you for sponsoring the bill.
Well, I thank you for your comments. Question for any of the four of you. Any of you ever heard of TRG, an insurance company? Well, they sold health insurance in 49 states, every state but their own state. People died because they didn't pay claims. They paid their premiums. The insurance company just never paid any claims. They were protected from the states for years under ERISA. The federal government did nothing, zero, not a zilch, to stop the perpetrators of this horrendous crime against honest, law-abiding citizens who were just trying to insure their loved ones for future misfortune, health misfortune, which they had. There never was any justice until 13 different state agencies got together for the first time in history, crossed state lines to enforce crimes, insurance crimes, and pretty precedent-setting matter. The point is that the state regulators made that happen. The federal regulators did nothing. And so I learned a lot from that experience, and I cannot thank the state regulators enough for their dedication and actually their ability to get things done and protect the consumers in ways that the federal government has never been able to do. They write plenty of regulations, but there are federal statutes that would have made those perpetrators serve life in prison because people died for them failing to pay for their coverage, yet they never pursued those cases against them. So thank you very much, Mr. Chairman. I yield back.
Gentleman's time has expired. With that, we go to the lady from New York, Ms. Velasquez. She's recognized for 5 minutes.
Thank you, Mr. Chairman. Director McRae, one area of the market particularly important to my constituents is affordable flood insurance. As you know, many homeowners in New York City face enormous rate hikes in the aftermath of Superstorm Sandy. What role does the FIO play in studying the flood insurance market, and what suggestions do you have to keep it affordable?
Treasury certainly has an interest in the flood program. As you know, the Treasury lends money to the National Flood Insurance Program. The NFIP is administered by FEMA within DHS. And they, of course, do their best in that work every day. To the extent that they have asked for or sought our assistance or our perspective, we've been happy to share that.
Thank you. Mr. Sullivan, the state risk-based capital regime is focused on policyholder protection. Yet, the Federal Reserve supervisory system takes a far more macro approach to protect the safety and soundness of the entire financial system. How can the Federal Reserve establish a supervisory framework for insurance companies to protect both policyholders and preserve financial stability?
Thank you, Representative. Ours is a macro role, and we do look at our role as that looking at the entirety of the enterprise. As I said in my opening statement, we don't intend to replicate the work of the states, and we will defer. We are absolutely deferential to the states in their mission to protect policyholders. I was once a state regulator. I take that very seriously, and I think the state regulators are doing a fine job of protecting policyholders.
Thank you. Mr. Hoff, would you like to comment?
Yes, well, we have a good working relationship with the Fed. You may know Missouri is the only state with two Federal Reserve banks. And so we have the Kansas City Fed and the St. Louis Fed, and we also have a good working relationship with the Fed here in Washington. So, but we do take protection of policyholders. That's our #1 priority, and of course, building competitive and maintaining competitive markets. But everything we do in terms of financial regulation starts and stops with protecting policyholders, whether it's looking at the strengthening our RBC system, and as we work on capital standards, or if it's our work related to reinsurance collateral and our work on covered agreements. So we do start and stop with policyholders.
Thank you. Mr. Hoff, in 2013, the New York's Superintendent of Financial Services found life insurers were exploiting the state-based regulatory scheme to inflate their books to the tune of $48 billion. This revelation has troubling similarities to the issues surrounding mortgage-backed securities that precipitated the 2008 financial crisis. Don't these practices threaten the legitimacy of the state-based insurance regulatory structure and in turn fuels call for more federal involvement?
Just to clarify your question, were you talking about the New York study on captives?
The New York Superintendents of Financial Services found life insurers were exploiting the state-based regulatory scheme to inflate their books.
Yes.
New York Times article.
Right. I think you're talking about the New York Times article now about the use of captives. And we've made a great deal of progress. As I said in my opening comments, really the origin of captives was in large measure to address with admittedly excessive reserves, primarily when we took a look at it in term insurance and universal life insurance with secondary guarantees. So what we did was we began with a study of life insurers in 2012. We finished a white paper that outlined these issues in 2013. And then in 2014, the NAIC adopted a comprehensive reinsurance framework such that a life insurer will be allowed to take financial credit for the reinsurance transaction with its captive only if certain financial criteria are met. And a very consistent reserving method was developed and adopted by the NAIC. You may have heard of its Actuarial Guideline 48, and it was effective 1/1/15 on all new policies issued. So we've taken very certain action on these life insurer captives. Of course, our permanent solution to address this is our principles-based reserving methodology.
So you are confident that these issues have been taken care of?
I'm confident we're on a path to take care of them. Yes, ma'am.
Thank you, Mr. Chairman.
Thank you, gentlelady. Your time's expired. With that, we go to the gentleman from Pennsylvania, Mr. Rothfuss, for 5 minutes.
Thank you, Mr. Chairman. Mr. Sullivan, Chair Yellen, in testimony before the House Financial Services Committee this year, stated that the FSOC has not discussed pursuing an activities-based systemic risk review for insurance companies. What is the rationale for not pursuing an activities-based systemic risk review for insurers?
I think you should direct your question to the chair. She is the seated member of the FSOC. I believe.
So, are you aware, has the FSOC conducted a study or analysis that demonstrates that it is inappropriate to use an activities-based approach to regulating systemic risk review for insurers?
Can I have your question again? I'm sorry.
Has the FSOC conducted a study or analysis that demonstrates that it would be inappropriate to use an activities-based approach to regulating systemic risk review for insurers?
I'm not aware of what the FSOC has or has not conducted for studies.
Mr. Woodall, in your written testimony, you discussed the benefits of incorporating an activities-based systemic risk approach and the exit ramp that should follow based on activities or combination of activities identified as riskier than others. Both Treasury and the Fed have testified that a path to de-designation is available, but have been hesitant to provide details. Do you believe that a SIFI designation exit ramp exists?
Well, as I said in my statement, I think that it should exist, but I think right now the companies don't really know where that exit ramp is, whether it's multi-lane or not, as it's been called. It's hard to find, but I think going back to your other question about the activities-based, I think on the other side of the question you asked, FSOC has looked at the activities thing in regard to asset managers, and they have essentially set aside making any further designations on any basis until they can look at the activities of the asset management industry as a whole, and that's what they're in process of doing right now. So I am encouraged that they are starting to look at the activities-based.
Mr. McRaith, in January, Congress passed the National Association of Agents and Brokers Reform Act of 2015, better known as NAREB 2. This bipartisan legislation was meant to streamline licensing compliance measures for insurance agents while maintaining a high standard of state-based regulation. As you know, NAREB 2 won't go into effect until a board is selected and appointed. Though the President signed this bill 9 months ago, it appears that little progress has been made on appointing a board, and the process of reform that Congress worked hard on appears to be at a standstill. Our chairman, Mr. Lukemeyer, wrote to your agency expressing his concerns and inquiring as to NAREB 2's delayed implementation. I was disappointed that Treasury's response to his letter was non-committal and failed to provide a meaningful update on the implementation process. Can you provide us with an update on the NAREB 2 board appointments?
Congressman, as you know, the law requires 13 presidentially appointed Senate-confirmed board members. We received the White House has received applications. Candidates are being considered, evaluated, vetted, and I'm sure at an appropriate time the White House will forward those
Has the Treasury Department completed its work on the vetting process?
We've done what we can to support the effort. I think the administration, which supports NAREB as an objective, continues to see the value and wants to see NAREB initiated as soon as possible.
Back to Mr. Woodall again. You have complained that your role in international negotiations as the only voting member of FSOC with insurance expertise has been constrained. Why do you think that is?
Well, essentially, what they call Team USA are the gentlemen to my right here, the 3 people that are involved at the IAIS. I have a duty as a member of FSOC to monitor international developments in insurance and accounting. That's the way it works. Obviously, Mr. McRaith has the charge, as he said, to represent the United States at the IAS as appropriate. I felt like that being the insurance expert on FSOC, I needed to be involved in the room where these systemic issues are being discussed. And that's what we talked about 2 years ago when I was before this subcommittee. At that time, several people said they wanted me in the room, and I tried to make an effort to get in the room.
Do you believe that the FSOC approaches international negotiations on insurance matters with a sufficient understanding of the industry?
Well, now, FSOC, I'm supposed to be the expert to try to advise FSOC. And right now, I can't say that FSOC has that comprehensive a view of what's happening at the international level. I think there is a feeling that the international may be driving that car, Chairman, as far as what's being done at the international level coming down then to the other. Because as you know, when our people are at the FSB and they make commitments to carry out something that the IAIS has done. As has been said many times, they can't guarantee it, but they consent. It's the consensual process. And that's what happened with the three companies, the insurance companies that were designated as global SIFIs. And two of those were before we ever even said they were a U.S. SIFI. And I really feel like that we've got a situation where the international people have been driving that car.
Very good. Gentleman's time's expired. With that, we'll go to the other gentleman from Missouri, Mr. Clay, for 5 minutes.
Thank you, Mr. Chairman, and thank you, gentlemen, for being here. Let me start with Mr. Sullivan. In its development of capital standards, the Federal Reserve's attempting to draw a distinction between traditional or core insurance activities versus non-traditional or non-core activities?
So as we construct a domestic capital regime, we will be looking at the totality of the enterprise, including insurance activities and non-traditional or non-insurance activities, because we are charged under the law with developing a comprehensive, consolidated capital framework. So we will be looking at the totality of the enterprises we supervise.
You know, stress tests serve as an effective tool for measuring the health of financial institutions. Will the Federal Reserve engage in stress testing for insurance companies?
Yes, likely at a minimum for the designated firms and in consultation as prescribed under Dodd-Frank with the Federal Insurance Office.
Will these tests specifically look at systemic circumstances and stresses to the broader financial system that could occur simultaneously with stresses to the supervised firm?
It's too early to speculate on that, but probably.
What do you think are the differences between testing stresses at an insurance company versus a bank?
Well, the business models are very different. And so, therefore, whatever stress testing regime we design needs to be appropriate and designed for the differences in the business models.
Thank you for your responses. Mr. Huff, as the International Association of Insurance Supervisors continues to work on the development of capital standards, some have raised concerns about its application in the United States. Mr. Huff, as a state insurance commissioner, can you discuss the steps that your department, for example, would take in reviewing any internationally developed standards and discuss what actions would need to be taken for those standards to apply in Missouri?
Thank you, Congressman Clay. And it is important to remember that nothing that the IIS does in terms of international capital standards, or any of the work they do for that matter, is automatically implementable in the U.S. For insurance firms, unless the NAIC, with the state regulators working collectively through the National Association of Insurance Commissioners, adopt those standards through its open and transparent process, then it would not be applicable to the insurance market, or unless the Federal Reserve decides to adopt those standards for their limited portfolio of the thrift holding company insurers or the systemically important financial institutions as designated by FSOC. So nothing would come directly from the IIS.
I see. Mr. Woodall, you have expressed concerns with international developments related to insurance, but as you know very well, while the federal government can certainly agree to reforms at the international level, domestic implementation would largely occur state by state. Even for implementation that would occur at the Federal Reserve Board, there would still be a notice and comment period prior to implementation. Can you please discuss in more detail the process that any state insurance commissioner would go through when deciding whether or not to implement international reforms in full or in part?
Well, I'm not a regulator at this point. 50 years ago I was. but I know how it works, and I know that each state has to look at it to see whether or not that's what they want to do. I think more than likely, some of these things won't affect that many states because there won't be that many states that have companies that might be subject to some of these things. Now, whether that would go down to internationally active companies is still a question as to how far some of the recommendations that come out of the international level will go.
Thank you for your response, Mr. Chairman. I yield back.
Thank the gentleman from Missouri. With that, Mr. Pierce from New Mexico is the next gentleman to be recognized for 5 minutes. Mr.
Thank you,
Pierce.
Mr. Chairman. Appreciate each of you being here, trying to sort through this situation that we face. Mr. Sullivan, you had mentioned to Mr. Rothfuss that he needed to direct his questions elsewhere, and we, in anticipation of that, did just that. We asked Chairman of the Board of Governors, Janet Yellen, after her last appearance here, about a couple of things regarding this particular issue. And we asked, does the FIO communicate and coordinate pre-planned policy objectives with independent state regulators, insurance regulators who are responsible for insurance supervision in the U.S.? Her response back was Team USA, that, yeah, we approach it as a team, and NAIC takes the lead in coordinating the views and comments of state regulators into the feedback to the U.S. members provide on IAIS standards. So my question to you is it safe to assume that the Fed does not propose any ideas before the IAIS or FSB without NAIC's approval or previous knowledge of those positions? So is it actually Team USA, and I'm visualizing Tour de France, the postal team on bicycles all riding and high-fiving each other, but the yellow jerseys worn by the NAIC? Is that the way it's going?
Well, we
Sort of?
we continue to work hard at our collaborative efforts.
You're far enough behind the yellow jersey, you can't hardly see them over the hill, huh?
I would tell you that it takes hard work and good old-fashioned shoe leather to
That'll
be
harder.
committed to the process. And
All right, Mr. McRae, you got an opinion about that? About the communication process and the NAIC taking the lead?
The key for our work is that we're working together, building consensus as a group. That's what
I didn't ask that.
that's what we've done
Would you agree with
today.
the assessment that nothing goes before it's run by the NAIC?
As a practical matter, and as the GAO noted in its report about 7 weeks ago, that we are all working together to develop consensus.
It's not going to answer the question. I mean, I'll quit asking you questions if you don't want to answer. Mr. Woodall, now Mr. Rothfuss brought up, he was kind of dragging into this direction, but the crafting of international standards, I think Mr. McRae said that we're trying to craft international standards that will be acceptable to the U.S. market. Mr. Rothfuss sort of got into this. Is it your opinion that we're actually doing that? Are we crafting standards that will be acceptable to the U.S. market? I mean, led in with how it's a big piece of the world equation and that, and so is that actually occurring?
Well, it's really hard for me to say because, as I mentioned, I'm not a member of the Team USA.
Have you ever objected
I'm
on
not
anything
in the
like
room.
that? Have you ever dissented on any of these comments before?
Which comments, sir?
Anything along this track that says that, hey, we're running a nice tight ship here and we're Team USA and we're moving right along? That's nothing that you've ever,
Well, no, I've just tried to get in the room with them and have not been successful.
okay. Mr. Huff, you said that the protection of the policyholder is your number one priority. Is that viewpoint shared by the feds and FIO?
I'll let the Fed and FIO speak for themselves, but our number one mandate continues to be the protection
I
of
mean,
U.S.
but you heard my
policyholders.
comment from the chairman that you're the one taking the lead here. You're wearing the yellow jersey. Everybody's following you. Is that actually occurring or is that not?
Well, we certainly are
I know you're
taking
afraid
the
of what's
lead.
going to happen after you answer the question. If you
Right.
do, so
Well, I'll tell you one
off
place
the
we're
hook if
taking the
you'd
lead.
like.
If I could give you an example of where we are taking the lead, we are moving forward with the group capital calculation. State insurance regulators are getting together and moving forward. We'll have a concept paper later this year for our November meeting that would be at National Harbor in November.
Okay, so you also made the comment that no case has been made, and you don't want the system to compromise the state systems. Is that a viewpoint you would share, Mr. McRae? You're trying not to compromise these state systems that Mr. Huff says have been working pretty well, and no case has been made to overturn them for international standards?
Absolutely. The global standard setting does not get into the structures or the architecture of a country's regulatory system. In our view, the state system works very well. I was a former state regulator, as were my colleagues on this panel. I think the
This is true
system
confession.
does an
Several of
excellent
you have
job
been
of
out there in the
protecting
state
consumers.
regulator system. Okay, thanks. I'll yield back, Mr. Chairman.
Gentleman's time's expired. We now go to the gentleman from Texas, Mr. Green, for 5 minutes.
Thank you, Mr. Chairman. I thank the ranking member as well. I thank the witnesses for appearing. Mr. Woodall, you have raised questions about SIFIs and how they can be delisted. Is your question, how can a specific entity, company, corporation be delisted, or is there a means by which you can have a standardized methodology in place for delisting?
Well, so far, we've just talked about the individual SIFIs. And I think in that case, what I was saying, that these individual companies don't have a roadmap as to how to get off. Now, there's one that we've talked about, the insurance companies, but GE Capital is the fourth SIFI that was designated. And as you probably know, it's public information, they're in the process of getting rid of all their financial activities and probably will lose their SIFI identity. But I'm not sure that insurance companies are in a position to do the nuclear option and get rid of all their financial business in order not to be a SIFI. Now, as far as the group, I think
Let's
that's
do
what
this
we're
for
looking
just
at with asset
Woodall,
managers.
let me do this, because I'd like for Mr. Sullivan to respond. I'm interested in hearing his take on it. Mr. Sullivan, Mr. Woodall makes a point that because of the nature of the business of insurance companies, delisting becomes a bit more difficult than for a GE Capital. How do you respond to that?
Well, Representative, mine is to design the regulatory regime and architecture for firms after they are designated by the FSOC. So what I'm doing in my day job is doing just that, making sure that we put together a regulatory regime designed for firms designated by the FSOC.
So no one on this panel can address Mr. Woodall's question, then I take it?
Actually, Congressman, just to be, I think it's important to be factual in this conversation. The firms that are designated by the council, after following months of engagement with the firm, thousands of pages of analysis, hours spent with the firm by all council members, the firm designated receives several hundred pages of analysis that provide detailed and explicit statements about where the council sees risk or threats to financial stability in the firm. So the firm does have a very clear sense of the basis for the council's determination.
I understand, but Mr. Woodall seems to be asking another question, not what is it that caused the company to become a SIFI. He seems to be asking what can be done so that the company can no longer be a SIFI.
That's the difference. That's the next point from what Mr. McRae
Mr.
said.
Woodall, now you got to let me have a minute here now. My time is very limited. So how do you address his question? I think he raises a good question, and I'd like to hear a good answer.
The council has an annual review process for firms that have been designated. So each year, and that process was enhanced this year based on stakeholder and public comment and comments from members of Congress as well. So each firm designated has an opportunity to come to the council, provide information about how it's changed its approach over the course of the year. And throughout the year, the council and its staff and members who serve on the council have an open door policy whereby a firm designated can come in at any time, share any information, and provide any insight they'd like to.
I see. Well, let me just make this comment. It seems to me that we're talking about something similar to strict liability. As you know, we have negligence and intentional torts. But you can also be liable just because of the inherent nature of what you do. And I think Mr. Woodall is getting to this point. He doesn't believe that insurance companies are inherently dangerous to the extent that they become SIFIs and they're never going to cease to be SIFIs. So the question becomes, and I'm going to visit more with people about this, just curious now because of the way he raised the question. How do they, we're new in this, we're in our infancy. All of this is fledgling in a sense. And given that we're in our nascency, these kinds of questions do have to be answered. And perhaps with more opportunities, we'll get some answers. But I'm still curious about Mr. Woodall's question of moving from designation to no longer being listed, or de-risking is the case with GE Capital. But thank you very much. And Mr. Chairman, you've allowed me 11 seconds more than I deserve. I yield back.
Always glad to accommodate the gentleman from Texas with his wonderful insights to have a couple extra moments. Thank you, Mr. Green from Texas. With that, we'll go to the gentleman from Kentucky, Mr. Barr, recognized for 5 minutes.
Thank you, Mr. Chairman. Thanks to the witnesses. And there's been much discussion outside this hearing and, of course, today in this hearing about the sequencing and the timing of the both the international capital standards and our new domestic capital standards under the fix to the Collins Amendment. For Mr. Sullivan, I'd like to kind of drill down a little bit more on the timing. Do we? I know you said we're working on our own timeline. Do we have any kind of ballpark time frame in terms of the draft of capital standards, and what? Give me an idea of the process. Is there going to be a notice of proposed rulemaking?
Yes, we are committed. We've said to this committee and other members that we are committed to a formal rulemaking process. We will not be doing it by order, so we will publish a notice for proposed rule. We will solicit interested party commentary when we've reached a point where we actually have the architecture and design of the capital framework better nailed down.
For Mr. McRaith and Mr. Sullivan, how much does your work at the FSB and the IAIS influence the development? You say you're very deliberative and you're seeking input. How much does that work over there influence the development of the capital standards here?
I'll go first. I don't want to race you, Mike, but I would say that, when we attend international fora, representative, other regulators around the globe are quite interested in, what the U.S. view is. As Director McRaith pointed out, we are the world's largest insurance market, so I think the rest of the global regulatory community would stand up and recognize, what the U.S. does. So I think it does go back to the chairman's earlier questions around, the importance of getting things right, and we're cognizant of that, and we want to make sure we're deliberate and we do nail it down.
Can you give me an idea of the progress of the international capital standards? Because we're hearing that whereas you're on your timetable here and it's very deliberative, that the IAIS they're pushing ahead. So is there a risk then that the sequencing is going to be backwards?
So we always, have the fallback that we don't have to adopt an international standard if it's not suitable for our market, right? So we've said that a number of times here today and in the past. But that being said, sequencing here, one is a fulfillment under the law, what we do in terms of fulfilling our obligations under the law. The other is standard setting. And I would describe this standard setting climate as much more evolutionary because it has to be. Director McRaith has used the term, when talking about the International Capital Standard, ICS 1.0, and how ICS 1.0 will look much different, or may look much different than ICS 10.0. And I would share that view that the developments in the international standard need to evolve and morph over time, over a much longer time period. And we were successful in removing some of the time constraints that were in some of the goal statements that were previously published by the IAIS.
And I would just encourage you all, as representatives of Team USA, to be prepared to back off and push back from the IAIS negotiating table if you perceive them getting ahead of you all. That's number one. Let me just shift over to Mr. Huff really quickly. One of your colleagues who was before this committee, Kevin McCarty, the Florida Insurance Commissioner, said at a Senate Banking Committee hearing earlier this year that in regards to international capital standards being developed and the historical differences between the United States and European approaches, when you try to harmonize those two, you're creating the potential for great disruption in the delivery of different services in the marketplace, a potential rise in the prices for consumers in the United States that potentially jeopardizes the availability of products. So to Mr. Huff, how are state regulators and the NAIC working with the Fed to make sure that domestic capital standards are finalized before completion of the international capital standards?
Yes, thank you for the question. So we are actively involved at the IIS along with the Fed and FIO and with the state insurance regulators and a full complement of NAIC staff. So it is very important that we continue that work even when we reach disagreements with the IIS process, because we always do have that ability to walk away. But what we are doing, the state regulators are doing, is we're moving ahead with our own work on a group capital calculation to be used as a consistent regulatory analytical tool for all U.S. insurance groups. And by building this calculation tool, we're able to assess group capital and then make and have an open forum with open and transparent forum with industry and with consumer groups, and then allow the Fed and FIO also to participate as we build that tool. So that will help us as we inform our work at the IIS.
Thank you, and I know Mr. Sullivan testified they're collaborating with you. Appreciate you collaborating with them, and Team USA, go first. Thank you.
Thank the gentleman. Time's expired. Understanding we have votes at 3:45 that have been scheduled. I think we probably have time, if everybody stays within the 5 minutes here, to be able to get everybody in today. So with that, we'll recognize the gentlelady from Wisconsin, Ms. Moore, for 5 minutes.
Thank you so much, Mr. Chairman. I want to thank the panel for this very important hearing. I guess I want to follow up from my colleague, Mr. Huff. I note that in your credentials, you've served as a state insurance commissioner for Missouri, as well as served on the FSOC. And pardon me, I wasn't here for the beginning of the hearing, so just indulge me. Perhaps you've already answered this question. You have indicated that the FSOC perhaps does not have the knowledge base and doesn't see the dissimilarity between the insurance industry and the banking industry to perhaps serve, to perhaps designate folks as SIFIs or to undesignate them as SIFIs. And I am wondering what you think ought to be done to enable the Federal Office of Insurance and the FSOC to have more insight into what ought to be done with regard to regulating the insurance industry.
So thank you for the question. So I have not yet spoken about my FSOC service, and I did serve 4 years. I was one of the original members of FSOC as a non-voting member representing state insurance regulators from fall 2010, and then I served until September just of last year. And I did issue a dissent, a non-voting dissent on the prudential designation. And I echo Mr. Woodall's comments on the exit ramp, if you will, for the designation. So I do believe it's a failure of FSOC to not set forth a clear rationale for the reasons for designation. Because really they're not giving the company an ability to de-designate, but more importantly, FSOC is not giving the primary regulators, and in the insurance space, that's the state regulators, not giving the state regulators the identification of those risks that need to be mitigated. We don't yet know what the impact will be of a designation because the capital standards are still pending. But at some point, additional capital standards will be applied to those firms that are designated. And then we will have a distortion in the marketplace of firms competing head-to-head, one against each other, one with a different cost of capital. We don't know how significant that will be, but we think it's only fair that FSOC come out with a clear exit ramp, not only for the company, but for state-based regulators.
Thank you for that. And this is for Mr. Woodall, or maybe Mr. McGrath. I'm very interested in private mortgage insurers who are recapitalized, and I believe that there ought to be at least a continued option for placing private capital in the first loss position. Unfortunately, there's been a discussion around here of completely destroying the GSEs, and I don't believe that there's enough private capital to fill that gap. So the FIO report outlines some of the past problems, issues, but I'm real interested in what you think the future is going to look like, what it ought to look like with regard to private mortgage insurers.
The private mortgage insurers suffered greatly through the crisis. They are in a stronger position right now. In fact, I think some recent entrants into the market are domiciled in your home state.
They are in my city.
Right, and we're pleased to see that. We do want to see more private capital in that space. It promotes home ownership in a way that supports people of low and middle incomes when they seek to purchase a home. That's excellent public policy and a goal that we all share. In terms of the housing market more broadly and the housing finance system, I think I would defer to my colleagues at Treasury who are more expert in that conversation.
Okay. Just one quick, I have 30 seconds left. I guess I'm real interested in the auto insurance. I guess I'm interested in, Mr. McGrath, why of your statutory responsibilities you decide to focus on the auto industry first?
We, by statute, are required to monitor the affordability and accessibility of non-health insurance to traditionally underserved communities.
And just very quickly,
we took
yeah.
auto because studies show auto insurance and automobile ownership enable lower income people to commute to jobs that they need.
Exactly. Exactly. So we don't want to cut off that credit to low-income people. Already low-income people are suffering tremendously from the pendulum swing of financial services being available to them. Thank you. Thank you, Mr. Chairman, for your indulgence.
Gentlelady, her time's expired. With that, we go to the gentleman from California, Mr. Royce. He's recognized for 5 minutes.
Thank you very much, Mr. Chairman. Director Huff, I'll just go back to some of your testimony. You mentioned that 32 jurisdictions have now passed legislation implementing the NIAC model reinsurance collateral law. But the reality is that 4 years is a long time, and we're still at a point where major states like Texas and Illinois are not part of that. And so I was wondering, if you say that we need to avoid the variation between the states by reducing collateral requirements in a consistent manner, it looks to me like by your own test, we're not close to implementing this, and the presumption I would have had was that that the pressure that would have been applied by the threat of a covered agreement might have brought everybody to the table. The worry I have is that since 1871, we've been trying to get the states to adopt a common framework. And give me your thoughts on why you think this is going to be done in a timely way and stave off the problems that I anticipate here.
So on the topic of credit for reinsurance revisions that have taken place, the process has been deliberate, it's been very methodical, and it's very measured and transparent in the way we are reducing collateral for foreign reinsurers. We have had 32 states. That's about 2/3 of the U.S. market, about 66% of the U.S. market in terms of premium. We have 5 other states that are seriously considering it and are ramping it up for their legislatures to consider, which will take us over 90% to about 93% of the market.
If you can get there.
Yes.
But I'm just gonna, by way of example, if we went back through testimony in the past in terms of how many times we thought we were a year away from achieving this goal from 1871 on in terms of reaching unanimity, it hasn't happened yet. Now, 4 years may not seem like a long time frame by that standard, or certainly by congressional standards, to be fair here. But I'm highly skeptical that you're going to bring states into line based upon what I've seen in past performance here with respect to getting this unanimity.
Well, Congressman, I would point to the fact that we have yet to have the decision whether we would make the credit for reinsurance revisions an accreditation standard. So I'll give you the example that we just went through for Model Holding Company Act, a model that we developed in 2010 to allow insurance regulators access to the information from the holding company. That model was developed in 10, is an accreditation standard as of 1/1/16, and we plan to have all 50 states plus DC having adopted that model. As we, in November, start the conveation about accreditation for credit for reinsurance.
I understand.
That's a hammer we have, is my point.
Okay. Director McCraith, as you know, I shared this with you today, I sent a letter to the Treasury Secretary and the USTR calling for a covered agreement with the EU. Based on your diligent work on this issue, I assume you agree that such an agreement is a positive tool that the U.S. should use in attempting to tackle reinsurance collateral and make progress on the question of U.S. regulatory equivalency.
That's exactly right, Congressman. What we know is effective January 1st, 2016, the European Union, which is the largest consolidated market in the world, will be subjecting U.S. insurers to regulatory standards that differ from those applied to insurers domiciled in some other jurisdictions. A covered agreement will provide clarity, finality, and certainty for U.S. insurers that either are now or seek to operate in the European Union market.
Let me jump in on another topic. On January 27th, the Homeland Security Chairman, Mike McCall, and I sent an unanswered letter to the President asking how the administration classifies and defines different types of cyber attacks. Specifically, we asked whether the use of different terms like cyber warfare, cyber vandalism, cyber terrorism would impact the Treasury Secretary's authority to certify a cyber attack as an act of terrorism under TRIA. So I assume this is a question you have contemplated as part of the larger question, and I think a clear statement from Treasury on what is and is not covered under TRIA as it relates to cyber terrorism would increase certainty in the market and help encourage additional capacity for cyber insurance. Can you help make that happen?
Absolutely appreciate that perspective. The statute, as you know, does not specify what are the causes or types of terrorist attacks. And in 2007, when I testified as a state regulator in support of renewal of TRIA, nobody talked about cyber. So the fact it's not specifically listed does not mean it's not included. If an event, a cyber event or any kind of event, satisfies the statutory criteria, then it is eligible for TRIA certification.
Thank you, Director.
Gentleman's time has expired. With that, we go to the very patient gentleman from Michigan, Mr. Kildee.
Thank you, Mr. Chairman, and I thank the witnesses for your testimony. I do want to follow up very briefly on the question that Ms. Moore raised right at the very end. So if I could start with Mr. McGrath, and I appreciate your work and your willingness to confer with me in the past on issues important to the industry. But I want to follow up. When Ms. Moore asked why FIO determined to make auto insurance the focus of your first steps toward implementing the specific responsibility regarding affordability and access, you indicated, I think appropriately, that often it's the barrier, perhaps, of transportation, access to affordable transportation that could stand in the way of an individual living in an impoverished community from access to economic opportunity. I don't want to put words in your mouth, but implicit in that is that there may not be available, affordable insurance to some of those populations. And I wonder if you would just perhaps elucidate a bit more on what would cause you to conclude that, and I don't disagree with the conclusion, don't get me wrong, that is a problem that needs to be addressed. If you could just touch on that. And I actually, Mr. Huff, perhaps because of some of the communities within your state, you might make the same observation. Go ahead.
You're absolutely right in the sense that transportation and personal vehicles allow people to have more than one job, to deal with children. Often people don't own a home, but do have a car because they need it to survive. We know that. Now, whether there is an issue with affordability and accessibility is an issue debated within the insurance sector. Some people would say no because the residual markets are very sparsely populated. Others would say yes because there's a relatively high percentage of uninsured in urban areas. What we're trying to do, Congressman, is establish a standard to answer that question exactly and precisely for you.
But do you, just based on your experience in Illinois, for example, and Mr. Huff in Missouri, and I know anecdotes are often difficult to extrapolate to a larger trend, but is it safe to say that it's certainly the case in older, particularly impoverished communities, that the cost of insurance is often beyond the reach of many of the individuals because the premiums are much greater in those communities than they might be in a neighboring community with fewer challenges?
That is a fair statement, and certainly the state of Michigan, we know, has some issues and challenges with the personal auto market, and I think your statement, broadly speaking, is true.
Mr. Huff?
Thank you. So NAIC does have an auto insurance study group, and they've already been conducting some of our own analysis related to low-income households and the auto insurance marketplace. And we issued a report last year that included some consumer and industry perspectives, as well as an overview of state programs and initiatives to address these affordability and availability issues. I will tell you, in my state, we collect data not only for auto, but also for homeowners at a zip code level. And that's very important because then you're able to work through any issues, identify if there are any issues in certain zip codes that may require action by the regulator. You may have missed my opening comments or comments that I made to Congressman Cleaver's question. Right now, Missouri has a very competitive auto market. We're just been named the 7th most competitive in the country. So our auto industry, we have about 175 carriers actively writing business, and as you noted, or as Director McGrath noted, our residual market has almost no participants. So we're in pretty good shape on the auto side in my state, but I'm very sensitive to these areas, issues in other states as well.
So maybe starting with Mr. McGrath, could you address the tools that a state insurance commissioner might have available to them, or statutory approaches at the state level, that, assuming that there would be some disparity that's not going to be overcome by just increased awareness, what tools would a state commissioner have at their availability to deal with significant disparity, lack of access to insurance, auto insurance in particular?
The regulatory tools vary state to state. The cost drivers vary state to state. Generally speaking, I think Director Huff made an excellent initial point, which is information is essential. Right. And presently, Missouri collects information and a couple other states do, but by and large, detailed information about personal auto market and cost on a zip code basis is not collected. So information is the first tool that a regulator has. And then in other states, there are rate regulatory mechanisms where the state regulators can evaluate the rate proposed by the firm and then decide whether to approve or disapprove that. But again, it depends on the state. In the state of Illinois, for example, we did not have rate approval, and frankly, in many cases and in most parts of the state, that worked just fine for us.
Thank you all. I thank you for your testimony. Thank you, Mr. Chairman, for your indulgence.
Gentleman from Michigan's time has expired. With that, we recognize the gentleman from Ohio, Mr. Stivers, for 5 minutes.
Thank you, Mr. Chairman. Thank you for this very important hearing. My first question is for Director McGrath and Mr. Sullivan. So the IAIS is issuing its first version of the high loss absorbency rule, which is a capital surcharge on 9 of the world's largest insurers, 3 of which are headquartered in the United States. And the IAIS is about to, at the same time, launch consultations to revise 2 of the important components of HLA. First, the definition of non-traditional insurance, and second, the assessment criteria used to designate systemic insurers. I'm curious if you think that we need to maybe change those 2 critical elements of the formula before finalizing the capital surcharge, which is largely based on those 2 components.
You're absolutely correct. The HLA that's developed this year, and I mentioned this earlier, is just the initial version, the initial iteration. It is subject to change because many of the components are in flux. The document itself, when it's publicly released, which will be soon, will explicitly state it is subject to change depending upon revisions to NTNI and the GSI methodology. So your point is exactly right, and the U.S. participants at the IAIS strongly supported and endorsed that concept.
Great. I'd like to move on to Director McGrath on the, Mr. Sullivan, did you have anything to add to that?
I would associate myself with all those comments.
Oh, great. I do want to move on, Director McGrath, to something that the gentleman from Michigan was just talking about. So with regard to your study on underserved communities and the affordability of insurance products, especially auto insurance, I'm curious how you chose to define affordable, and why did you choose that definition of affordable? If you can be very brief on that.
We have not settled on a definition of affordable. We have now offered 2 Federal Register proposals and received comment. We're working to get to the best approach, recognizing that it's not going to satisfy everybody.
Great. I appreciate that. And I'll tell you, I'm very concerned about a very big data call like this, where there's a lot of publicly available data. If you would choose a definition of affordability based on consumer spending, you'd get a lot of opportunity to use Bureau of Labor Statistics data. If you would go another direction, you could get a lot of NAIC data. I just feel like it's really important for you to use publicly available data first before you have a very large and burdensome data call. Can you comment on your thought process with regard to that?
One of the questions that we ask in both of our Federal Register notices is what are the best sources of data and information? We completely agree with you. Publicly available data is best. We have no desire, no objective to initiate some data call. We want to obtain information that satisfies the statutory mandate, but we do not want to increase the burden on industry participants. We certainly do not want to increase the burden on our limited resources. We do have to meet the mandate of the statute, and we're going to do that in an effective and efficient way.
Great, thank you. I appreciate that, and I appreciate the efficient and effective part of it, and obviously efficient is a part of it, efficient and effective. So please do your best on that. The next question I've got is for Commissioner Huff. With regard to your jurisdiction, regulatory jurisdiction, you have a lot of jurisdiction in your state over the regulation of annuities, and I'm curious if anyone at the Department of Labor has talked to you about their new rule with regard to fiduciary duty, and if what input they've gotten from you or what they've sought from you.
Yes, thank you. So we do appreciate the Department of Labor's intent to protect consumers as they make important decisions to provide for their retirement security. We were a bit dismayed. We were not contacted before the rule was put out by the Department of Labor, but we have been contacted as state insurance regulators through the NAIC. We have engaged with the Department of Labor and the administration since the proposed rule was released in the spring. There are obviously some issues with the rule on clarity, and there's quite a bit of regulatory uncertainty in what's in the rule today, and we've expressed those concerns to the Department of Labor.
I appreciate that, and I hope they'll reach out to you, the SEC, FINRA, the Treasury, and IRS. There are a whole bunch of people in this space, and it seems like the Department of Labor has not been very coordinated or information-seeking in their efforts. Thank you. I yield back, Mr. Chairman.
Gentleman's time's expired. We go to the gentleman from Minnesota, Mr. Ellison, for 5 minutes.
Thank you, Mr. Chairman, and also thank you to the ranking member. Director Wraith, I want to thank you and your team for the 2015 annual report. It's good job. The American families need and value quality and affordable insurance to enable their financial stability. And I wanted to ask you about a couple of things in the report. Last year's report did not mention title insurance, and I'm happy to see that this year's report does mention title insurance. And I've asked for a quote from Treasury's annual insurance report to be shown on the screen, which you can probably recognize up there. And I guess my question is, could you describe for me how your team feels about the present state of affairs regarding reverse competition and kickbacks in the realty industry?
Congressman, I think our report speaks for itself in the sense that it's an issue in the insurance sector. It's something that several states have expressed concern about. We think state regulators, the states should be looking at this closely. We look to monitor and assess those developments as we move forward.
Well, so thanks a lot. And, in your view, is it unusual in the insurance world for a referral source to receive compensation, either in lower desk rents, tickets to special events, or shared ownership in other insurance products? Is that unusual?
I hesitate to comment on what's typical or usual or unusual, other than to say, clearly, in some cases, those practices were abusive, and law enforcement and others looked at them very closely.
Okay. Would strict liability in this industry, that is requiring underwriters to have equal financial liability for all of the actions of agents, ensure that home buyers get services in their own best interests?
I forgive me for not wanting to offer a view on a question of strict liability or appropriate causes of action, but I think we're focused on the issues with insurance, and look to support this committee and your interest in this subject.
Thank you for your hard work.
Sure.
Mr. Huff, I have a question for you, sir. Why should a referral source receive a financial benefit for the referral? Why should a realtor, mortgage broker, or builder benefit from referring a home buyer to a title insurance agent?
So that's an area that we are exploring very heavily. I know you've spoken to my colleague, Minnesota Insurance Commissioner Mike Rothman.
Yep.
He is very interested in this issue. We've established our NAIC Title Insurance Task Force. They continue to discuss the issue of affiliated title insurers and ways to avoid conflicted referral advice from entities we regulate that play a role in a home purchase transaction, which, as you know, for many people, that's the biggest transaction of their lives. So we've reached out to stakeholders. We are having the task force is meeting, collecting comments from regulators, and we'll discuss this further at our fall national meeting, which is being held in Baltimore this year. So in fact, I think we've reached out to your staff to invite them to hear what's going on in that task force. So this is an issue that's receiving regulatory attention.
Well, I appreciate it, and I want to say thank you to you as well. And I wonder if you might comment on the National Association of Insurance Commissioners and what they're doing to ensure home buyers are not harmed by reverse competition and conflicted referrals.
Well, through this task force, that's sort of the starting point, if you will, for insurance regulators to come together And then we'll make a decision at that task force whether there is action required, and then there's a variety of ways to do that. We can go through a model law, if you will, or a model regulation, and then decide how that's teed up for the states to consider at adoption.
Well, I want to say thank you for your work. I have a bill, Ensure Fair Practices in Title Insurance, H.R. 1799, and my bill prohibits the financial benefit for referral. So I would welcome, your input, and I just want to say thank you to the panel, and I will yield back my 25 remaining seconds to the chair.
Thank you, gentlemen, for yielding. With that, I would like to thank the witnesses for the testimony today. You guys have been great, fantastic, matter of fact. I know that I mentioned a while ago that one of the important aspects of this committee is oversight. I know that in talking with Mr. Sullivan and Mr. McWraith that they made comments to me that our oversight, the willingness of us to delve into issues and to support them and to push for certain protections for our insurance industry gives them the ability to push back at the international level in their discussions. So I think it's important that we continue to make that point to them, that we're here to push back or help them push back, and we're here to protect the domestic insurance companies and want to work with them with regards to international capital standards as well. But with that, without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for the response. I ask our witnesses to please respond promptly if you're able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. And with that, this hearing is adjourned.